So I feel this is one of the most overlooked aspects when it comes to investing in the stock market. In fact, this is one of the most important metrics you should look at before buying any company. In this video, I'm going to show you why dilution is killing your portfolio quietly and you don't even know it's happening. I'll also show you how dilution actually works and how companies are slowly killing your gains, along with how you can actually capitalize on this and make even more profits. Now, a lot of people here on YouTube sell some form of course. That is not me. I am not that type of guy. My only fee for information like this is that you gently tap that like button. It seriously does help to push this video out to a much larger audience. And if you want to join our eToro Discord for life, all you've got to do is sign up with eToro down on the pinned comment, deposit, make a trade, and you do indeed get lifetime access to our Discord. So why is dilution important? Now, dilution in simple terminology, we'll go through it in a second, is where a company is selling more shares at the market to raise capital. I'll give you a simple example in just a second, but there is a big misconception with a lot of new investors. I see it on the comments of my videos that if a company is diluting, it's actually good because the company uses this capital to grow a new project. And I'll give you the reasons why this is complete and utter nonsense in this video. I know that using this capital can speed up the growth rate of a company, but it's also seriously damaging investors who currently hold the stock. So let's dive into a simple example of why companies dilute investors to actually raise capital. I created a company called 𝐿WT in this example, and please ignore my artwork. I did not watch Art Attack as a kid. Neil Buchanan actually scared the pants off me. But over at the whiteboard, we can see we have 𝐿WT and we only have one factory. Factory number one, and it can maximum produce 100 bottles a year. We sell these 100 bottles at $10 and we make $1,000 in revenue. But this $1,000 in revenue is not our bottom line. Of course, to make 100 bottles of whiskey, we actually need to spend money in glass, we need to spend money in distilleries, and all the costs of employees. And let's say to make a bottle of this scotch, it actually costs us $9 to make. So you only make $1 profit per bottle, which means that we actually only make $100 in net income. So how do we increase our company's value? Because we are maxed out. We've only got one factory. Well, let's say we want to build factory number 2. And factory number 2, of course, will make roughly the same amount of bottles and make another 100 bottles a year, which means our company value, in theory, over time would double. But the problem here is to build factory number 2, it's going to cost us $300. And we can't afford it unless we save money for 3 years, which realistically no company is gonna do because they want to pay bonuses to staff and so on and so forth. So the way they can pay for this factory is by diluting. So we know that 𝐿WT Corp is valued at $10 a share and we need to raise $300. Now luckily we do have $100 from last year's income, so we only need to raise $200 from dilution. Now if we sell 20 shares at the market at $10, that will give us $200 in revenue. Now, if you're not following here, what this means is basically we are going to generate and create out of thin air 20 new shares and sell them to the market, to investors, new investors in the company or existing like me and you, at $10 a share. And by doing so, we raise $200 in capital. 20 shares times $10. Very basic math equals $200, and the company gets to keep this amount to invest into whatever it wants, pay down debt, even pay you a dividend. So that is how a company in essence raises money from dilution. That is the basic form. And from a growing standpoint like 𝐿WT Scotch Corporation, of course it makes sense. This company is a very small company and it doesn't have enough money to grow as fast as it wants. It's at full capacity. It makes 100 bottles, they fly out of the shops. They need more bottles, but they can't afford to grow the factory or create a new one. So it's a simple way of growing the business fast. And this is where investors mess up because they see the company is growing and dilution is needed to help push them to the next level. That's all well and good. But the big problem is it's shareholders, current shareholders, who get burnt with this setup. And I'll show you what I mean right now. So we have 𝐿WT Scotch Corp. I'm just going to call it 𝐿WTSC. And it's valued at $10 a share. Now, for the purposes of this example, we are not going to increase the share amount. We're going to say the stock is steadily staying at $10. Of course, it will go up and down with the market, but for the hypothesis of this example, it stays at $10. Now, let's say there are only 5 investors into 𝐿WT Corp. Okay, I'm trying to keep the numbers small for simple math reasons. And this investor here with a mustache is you. Yeah, that's my attempt at a mustache. I told you I didn't do art in school. But anyway, this guy is you. He's waving, look. And he is only got 3 fingers as well. And he owns 2 shares of LWT Corp. In fact, all of these investors own 2 shares. And the total shares outstanding is only 10 shares in the whole market. Which means that every investor here, including you, own, in this example as it stands, 20% of the company. You own 20%. You control 20% of the revenues, and you also have voting rights equivalent to 20% ownership of the company. It's very important this because the ownership you own of a company actually defines how much money you actually make. Now, as it stands, these people, these 5 people who own 10% of LWT Scotch, own 20% of the profits. Like I said, we know that they only made $100 in profit, i.e. $20 each. But if we want to expand LWT Scotch Corporation and raise this money, we said that we are going to sell 20 new shares at the market. 20 new shares are coming in at $10 each. So what they do then is they then go and sell it at the market, and loads of new investors come in, and it could be 20, it could be 1, come in and buy these shares, okay? I'm just going to draw 5 there, and we're going to say that they all buy 4 each. So now, as it stands with the total math here, we've added 20 new shares to the market, and we had 10 originally. So we now have 30 shares outstanding in the market, okay? LWT's happy because they got their extra $200 to build factory number 2. So now we know there's 30 shares outstanding, and you still own 2 because you didn't have enough money to buy more when they sold more. So that means your 20% ownership is now only 6.6% ownership. So whereas the revenue might go up, it might go down with the new factory. It might take years, by the way, for this factory to even be built. It might not work. It might work. There's so many uncertainties with growing companies. Who really knows? But the fact of the matter is, as it stands, your ownership in this example has gone from 20% ownership down to 6.6%. Now, of course, this is a very extreme example, but we see it happening with a lot of growth companies. This is why dilution is not good for current investors. And what happens when they want to build factory number 3, 4, and 5, and they add more and more shares over time? Your 20% is dwindling down fast, and the only option you have to keep your 20% is to buy the new shares on the market, which means you are investing more and more and more. Now, there's a few things to look out for here when it comes to investing into a company that is heavily diluting. First thing is, investors do not like dilution. So when this news comes out that they're heavily diluting, the stock price tends to fall downwards, which means not only has your 20% gone to 6, but your overall value in stock price should have gone down too. Now, the opposite might happen, that they bring the news out that they're actually going to build a mega factory creating 5 million bottles of whiskey for $200, and then the share price might go up. And even though on your ownership of the company might be 6.6%, maybe the company's share price goes from $10 to $30, in which case your balance sheet, the actual money you've invested, will be pretty much the same. But this is where the problem lies. With companies that are heavily diluting, a lot of them, like Virgin Galactic, Nikola, a lot of EV companies right now, Palantir, a lot of Tattoo Chef, a lot of them do not have revenue. The only way they are making money to grow is through dilution. They don't have a net income left over to reinvest in their business. I know I said they don't have revenues. Correction, they do have revenues. They don't have any free cash to reinvest into new projects. Until that free cash comes, the only way they can expand and grow is by dilution and debt, and both are not very good. Now, of course, it is needed in a growing company because they need to grow to hit profitability. But again, it doesn't mean that it's a good investment for current holders. It means that you should probably just wait and see what happens with this company. More growing companies, more new companies fail than ones that actually make it in any sector throughout history. It's also worth noting here as well that over the last sort of couple of years, interest rates have been next to none. So if you were a company looking to raise a couple of $100 million, for example, cough Virgin Galactic, you could have took on debt at 0 interest rates or close to 0, and it would have not really hurt your bottom line. Or the other option is you hurt your current investors who took a gamble, took a leap of faith on you. But no, you chose to dilute rather than take on debt. You've got your own reasons. That's perfectly fine. Debt does stay on your balance sheet. You've got to pay it back over time. I get it. and dilution, you get the cash instantly and you don't have to pay it back over time. I get the reasons why, but as an investor, it's got to seriously upset you that the company is passing the financial responsibility onto the investors of the company rather than take the debt on themselves. And then you've also got the argument that maybe banks didn't want to lend the money in the first place. So we know dilution happens and it's not good. It's very rarely good for a company. Even though big companies, Alibaba was diluting only up until recently. And I think that it is needed for certain companies to dilute if they want to grow fast. I get it. I get the reason why. But if you are a company diluting, or you're looking at a company that's diluting, make sure they have enough free cash flow, enough money, they're profitable, to reason why it is a value investment. Because if they're not, and they're relying on diluting you to keep them alive and keep themselves growing because they have no cash flow, they don't have profits yet, then they're going to continue diluting you into the future. So you can't make a safe assumption right now the dilution is over. But on a positive note, there is something the opposite of dilution, which is share buybacks. Companies can actually take shares back from the market and increase your ownership of said company. If you look at companies like Apple and Facebook, they've been doing this heavily recently and rewarding loyal investors. They have too much cash left over. They don't have much debt. They don't have any new projects that need funding with all of their free cash flow. They've got too much cash. So they can do one of two things to help investors out. They can actually pay you a dividend with this cash, or they can buy back shares and increase your ownership of the company in terms of a percentage. But it's also worth noting here that when dilution and buybacks happen, companies still mess up on this point. If you want to be ultra critical, let's go back to the drawing board. If we have a chart here, and let's just put the stock is doing this. If you think about it logically, and let's say this is $10, and let's say this is $1, okay? Now, if LWT Corp wants to sell 20 shares, it's better selling the 20 shares in this range here, because that means it's going to get its $200, okay? But if it wants to get $200 in this range, it doesn't need to sell 20 shares. It needs to sell 200 shares to make the same amount of money. So when you see dilution, you want to see it happen on a stock that's ripping upwards and they're diluting, which means their shares that they're actually put into the market are less, so investors actually keep a bigger percentage. So if you see a company shooting up to the moon and they're diluting you, that's a better way than on the way down like Virgin Galactic, where they're diluting you as the share price falls, which means they need to add more shares to the market, meaning you lose even more ownership of the company. And it's the same with buybacks as well, because we've seen recently that Facebook put out pretty damn poor earnings, and they were buying back shares in this example in this region as high as possible. They then put out earnings which made the stock fall like 20%, and they knew this was going to happen. If they'd have kept this free cash and bought the shares back here, they'd have bought 20% more shares with their money, and they knew it was going to happen. It's obvious. They know their financials. They know what's going on in the company. I'd have much rather seen Facebook do that. I think Facebook will continue buying shares in the coming quarter at this current price. But again, you can see how a company is reacting to share buybacks and dilution in a positive or negative manner too. So I know we've covered a lot on dilution and it's been quite fast paced. And I'm really sorry if somebody has not caught up, but I promise you if you watch this video again and again, it will make more sense to you. Long story short, dilution on a company that is far from profitability and hasn't got a long-term history of profits and free cash flow, it's just not a good go. It's just, long story short, do not bet the farm. If the company has loads of free cash flow and is buying back shares as the stock price is going higher, I mean, there is examples like Apple where you have really no choice because it doesn't really fall that much, but you want to see the company buy back shares when the company stock price is cheap. That's what we want to see happen. So we want to see active companies and accountants buying back shares at cheap prices rather than high prices because the dollar goes further. And again, back to dilution, just long story short, it's not a good thing. And if you see big, heavy dilution in a stock that's falling downwards, Virgin Galactic, great example, just completely avoid it. In my opinion, not a safe bet. But also remember, just because a company is diluting, it does not mean it's a complete avoid. It does not mean you should not buy the company. It's just one of the key criteria I think investors should be looking at. It's one of my top 5 criterias that I look at. In fact, I'd probably go as far as saying it's probably the second or third thing I ever look for on a company. It's very important. And a lot of investors just brush over this amount because they don't understand what it is and they can't be bothered learning. So hopefully with this long-winded video, you've learned something. If you have, drop the code word down below, which is buybacks. If you want to see more on what value metrics I look at, check out that video out up there. And don't forget, there's a Discord down below in the description. Check it out and I'll see you in the next one. Take care. Peace.